Alright, we're looking at the All Ordinaries Index, and this is another graph or another tool that we can use to give us an idea of when to trade and when to buy and sell, but more importantly tells us how the whole market's going. If you've got some shares and you were just wanting to see how they were going, you might end up drawing a bit of a graph that may look something like this. So it's a daily graph price that goes up and down. This just might be your shares, and you'll be able to see what they're doing, but you don't actually see them what they're doing in relation to anything else. You're only actually seeing them of their prices. Now, you might not know if the whole market's going up or down, it's just the shares that are going up and down. So what we do is we use a thing called an index number or an indice. Now, index number just shows us the percentage change that these shares are doing over a time period. Now, if we use one lot of shares, it's going to be fairly volatile. It's going to go up and down. But if we use a whole lot of shares that are spread across a whole lot of different industries and different sectors, then what happens is you get a good indicator of what the market's going and what the market's doing. So in Australia we have the All Ordinaries Index, and that's an indicator of the market, and it shows the trend of what's going on. So this graph here shows a few years of the All Ordinaries Index in Australia, and you can see it going up and down all over the place. And basically, in the All Ordinaries, what happens is you have a whole stack of companies. Now, in Australia we have 300 companies in the All Ordinaries Index, and sometimes they change, sometimes they stay the same. They've got to have a certain market value, they've got to be trading a certain amount, and they've got to have a certain amount of liquidity in their shares. So they've got to be moving around in the market to have an impact on the market. And sometimes the stock exchange will change what's sitting in there, but normally your big banks and BHP and those other big companies are sitting in there because they actually have quite an influence on the market. So if you have a look at this graph here, we've got the All Ordinaries Index. It starts in 2008, it's quite high up here, and then we come down here. This is the GFC that's got us a little bit, and then we bounce back up, and it looks fairly strong here. And of course, this is 5 years. You may also have heard on the news and things like that, other indices, and the other markets around the world have a whole lot of other indices as well. So you've got the All Ordinaries Index in Australia, you've got the Nasdaq, which is a tech stocks in America, you've got the Dow Jones, you've got the FTSE 100, and there's a whole lot of other ones that are floating around as well. So if you just do a bit of a search, you can actually find these out. So let's have a look at the All Ordinaries versus the Dow Jones. Now, the Dow Jones is the main American indicator. Okay, so it's the Dow Jones. So this shows us what the American markets are doing. Now, it's said that we often follow what happens in America. So when something goes wrong in America, we follow suit. So people are a bit nervous if Wall Street, which is the main market in America, goes down, then the Australian markets will follow that. So let's have a look. The All Ordinaries one here is in blue, and the Dow Jones is in green. So you can see in January 09, when those shares went down for us for the GFC and those kind of things as well, we copied very similar to what was going on in America. So when something happened there, we kind of followed down. Now this green one is the American one, and the blue one is the All Ordinaries Index. So you can see we peaked and we dropped here, the same as America, but see how we recovered? We recovered quite strongly compared to them. So our market was kind of fairly good all through here, and it's going not too bad. Now you can see they're mirroring and they're a bit further away. Now this does not necessarily means that they're doing far better than we are and we're underperforming. What it shows is that maybe they're using different scales and things, so don't get too concerned about that. But you can see, look, there's a trend here where it goes down, and then there's a trend here where Australia goes down. So we are in a global market, and sometimes what happens over there happens over here as well. Now, our economy is probably being a bit more robust, so we haven't affected the GFC hasn't possibly affected us as much. Now, this is from January 2008 to January 12, so we're not looking at a really 4-year, 5-year period here. Now, what happens if we looked at a longer term? So once again, let's have a look at a longer term. So this graph is well spread out. It comes from Yahoo Finance, and you can see that the Australian market has gone quite well. There's a couple of times in the Australian market where we have done quite surprisingly well. Look at this bit here. Okay, the All Ords has popped up way above the American in this bit here. This is the crash of '87. And then we plummeted quite quickly as well. So when you look at that, we've gone down quite well. And then the market tends to goes up, and this is the bubble here that's lifted America up and probably helped maybe overstimulate their economy and allow people to borrow lots of money against their houses and those kind of things, hence the GFC kind of happened. But if you have a look over here, that's where we reacted. So Australia dropped down, America dropped down, and now we've been quite solid in our recovery, and so has America. So you can see that this is a good indicator. It just indicates what is going on in the market generally. Okay, so it's a very good indicator for us to what's going on. We'll learn how to make our own index, because then what you do, if you set up your portfolio and you can generate an indice off of that, or an index off of that, you can then match it against the All Ords and see how you are performing. So it gives you a bit of another performance of how you're traveling. So once again, this is another kind of key in when to buy and sell. So if you have your own index and you match it against the All Ords and you can see what your share portfolio is doing, you can make some better trading decisions. But generally, if you've got your shares spread across quite a few kind of industries, and the share market goes up and down, you're going to have a fairly good buffer zone, because not everyone's going to be affected. If there is a big crash like in 1987, then no matter what kind of stocks you have, you do get affected. But they do always tend to return back. So if you have a look here, even though we dropped here in 87, you can see our share market is now, similar to where it was. It's got above it. Now we're dropping a bit down the bottom here, but we are still generally above that level in 87 where we dropped down to. So once again, it's that long-term investment which seems to be good for this. Cool.